7 justices just drew a line that nobody expected them to actually enforce, and the financial consequences of that decision are already rippling through markets in ways most people won't recognize until it's far too late. The Supreme Court rejected absolute presidential immunity in a ruling that wasn't close, 7-2. 3 of those votes came from justices appointed by the man whose appeal they just demolished. That fact alone should tell you something about the gravity of what just happened. But here's what matters more than the legal theory or the constitutional debate. This ruling just removed the last shield protecting trillions of dollars in market confidence built on institutional stability. Let's start with what actually occurred. A former president asked the highest court in America to declare him functionally untouchable by law. The argument wasn't subtle. His legal team wanted a ruling that would make the presidency something closer to monarchy during tenure and even after leaving office. The special prosecutor laid it out in plain language. Accepting that theory doesn't protect one executive, it crowns a permanent ruling class insulated from consequences. The court said no, not quietly, not ambiguously. They rejected the entire premise with a clarity that legal scholars across the spectrum are calling one of the most definitive constitutional rebukes in modern history. Conservative commentators who defended this president through multiple controversies appeared on television unable to find a positive angle. That's rare. When partisan defenders have nothing left to spin, the underlying reality must be overwhelming. Now we get to why this matters for anyone with money in markets. Institutional legitimacy isn't some abstract civics lesson. It's the foundation everything else rests on. Contracts get enforced because courts say so. Property rights hold because legal systems protect them. Business disputes resolved through neutral arbitration rather than power contests or corruption. Remove confidence in that system, and you remove the basis for long-term capital allocation. Think about what investing actually requires. When you buy equity in a company, you're trusting that the rules protecting that company's intellectual property, its contracts, its operations, will remain intact and enforced fairly. You're betting that 10 years from now, courts will still function as neutral arbiters, that patents will still mean something, that agreements will still carry weight. Now consider what happens when a significant portion of the country decides courts are illegitimate political weapons, when judicial outcomes get accepted only if they favor your predetermined conclusion, when losing a case means corruption rather than weak arguments. What does capital allocation look like in that environment? How do you project earnings when foundational assumptions about rule of law are unstable? This isn't theoretical. Other economies have walked this path. Venezuela had the strongest economy in South America during the 70s. Institutional decay turned prosperity into poverty within a generation. Argentina ranked among the world's 10 largest economies in 1913. Erosion of legal certainty and property rights led to decades of stagnation. These aren't ancient cautionary tales. They're recent examples of what happens when institutions lose legitimacy. The United States built the world's largest economy partly through innovation and entrepreneurship, yes, but also through relatively stable institutions that made long-term investment rational, courts that mostly followed law, a constitution mostly respected, systems of accountability that mostly functioned. That stability isn't inherent or permanent. It requires active maintenance. And right now we're watching a sustained challenge to that stability from someone who commands fierce loyalty from tens of millions of people. 3 justices he personally elevated to the Supreme Court voted against his immunity claim. Neil Gorsuch, Brett Kavanaugh, Amy Coney Barrett. They chose constitutional principles over personal loyalty. That decision matters enormously, not because of who it helps or hurts politically, but because it demonstrates institutions can still function independently. The alternative would have confirmed every suspicion that courts are purely partisan, that justices serve whoever appointed them rather than the Constitution. Chief Justice Roberts has spent a career trying to maintain the court's legitimacy above partisan warfare. He understands that judicial authority depends entirely on public trust. Grant immunity to one person based on their office, and you shatter that trust permanently. You prove that different rules apply to different people. That power determines law rather than law-constraining power. The market reaction to this hasn't fully materialized yet, but look at what's already in motion. Trading floors in New York are tracking every development closely, not because traders care about constitutional theory, but because they recognize uncertainty when they see it. And if markets hate anything, it's uncertainty. Federal prosecutions are going to accelerate now. Without immunity protection, multiple cases move forward simultaneously. Classified documents. January 6th. Election interference. The evidence in these cases is substantial and public. Trials will proceed. Appeals will be filed. Media coverage will be constant and intense. And the person at the center of all this is not accepting the court's decision quietly. He's escalating, attacking the Supreme Court directly, calling his own appointees corrupt, suggesting the entire judicial system is rigged against him. His most committed supporters are adopting that narrative wholesale, claiming even conservative justices have been compromised by deep state operations. That rhetoric creates a dangerous dynamic. When you convince people that institutions are illegitimate, you're attacking more than political opponents. You're attacking the framework that makes modern commerce possible. Business depends on courts. Markets depend on enforceable rules. Prosperity depends on predictable legal structures. Erode faith in those structures, and economic stability erodes with it. Look at the pattern of loyalty we've seen. The Attorney General who recused himself from an investigation ethically was immediately labeled weak and disloyal. The Attorney General who defended controversial actions for years got attacked the moment he stated election fraud claims lacked evidence. The Vice President who stood beside him through everything faced a mob calling for execution after refusing to illegally overturn an election result. Supreme Court justices appointed specifically for their conservative credentials are now being denounced for following constitutional law. This pattern reveals something critical. Loyalty flows one direction. It's transactional. It extends only as far as absolute alignment. Deviation on any point, even when legally or ethically required, triggers immediate condemnation. That transactional approach to institutions is what makes the current situation so economically dangerous. Supreme Court justices don't serve the president who appointed them. They serve the Constitution. When they were asked to rewrite constitutional principles to protect one individual, they declined. That should be unremarkable. That's how the system is designed to work. But in the current environment, it's treated as betrayal. Markets run on confidence more than any other single factor. When investors believe rules apply consistently, when they trust institutions to function predictably, when they know courts will enforce agreements fairly, they allocate capital long-term. They build businesses. They take calculated risks. They invest in productive capacity. Destroy that confidence and everything changes. Imagine running a business with contracts worth hundreds of millions. Those contracts depend on legal enforcement. Now imagine the person who was president claims laws don't apply to him, that he can ignore contracts, change rules midstream, target opponents, all without accountability. How confident are your business plans under those conditions? How willing are you to commit capital long-term? This is why chaos matters more than specific policies. Unpredictability is poison for economic planning. Constant institutional attacks create systemic uncertainty. Messages that rules are flexible depending on who you are make long-term investment calculations impossible. The economy needs stability. It needs predictability. It needs rule of law applied evenly. When those elements come under sustained assault, when institutions get treated as weapons rather than neutral frameworks, business sentiment deteriorates. Capital becomes cautious. Investment horizons shorten. Risk premiums rise. We're already seeing stress indicators. Bond markets experienced unusual simultaneous selling with equities during recent volatility. When both stocks and bonds decline together, there's nowhere to hide. That's panic territory. Consumer confidence sits near historic lows. The University of Michigan Sentiment Index recorded 50.3 in late 2025. That's the second worst reading in nearly 5 decades of data. Consider what that means. We've endured oil crises, stagflation, multiple recessions, the savings and loan collapse, the dot-com implosion, September 11th, the 2008 financial crisis, a global pandemic. Consumer sentiment right now is worse than almost all those periods. And consumer spending represents roughly 2/3 of gross domestic product. When consumers pull back, corporate revenues decline. When revenues fall, earnings drop. When earnings disappoint, overvalued stock prices have nowhere to go but down. Current market concentration adds fragility. The 10 largest companies account for more than 30% of the S&P 500's total market capitalization. That narrow leadership makes the entire index vulnerable. When these mega-cap technology stocks stumble, everything follows. We saw this dynamic in late 2025 when tech led a broad sell-off. Tesla fell more than 6%. Palantir dropped 6.5%. Nvidia declined nearly 4%. Oracle lost over 4%, all in a single session. Now, layer on the additional factors. Stocks trading at 39 times earnings, consumer confidence at multi-decade lows, bond market instability, concentrated market leadership, massive federal debt, and a constitutional crisis where a former president attacks the Supreme Court for ruling against his immunity claim while facing multiple federal prosecutions. This is a combustible mixture. The pattern of denial preceding major crashes repeats consistently. In 1999, anyone questioning technology valuations got dismissed as not understanding the new internet paradigm. Traditional metrics supposedly no longer applied. Companies with zero profits traded at market capitalizations exceeding established industrial giants. Then the Nasdaq collapsed, and suddenly old-fashioned valuation metrics seemed relevant again. In 2006 and 2007, warnings about derivatives and housing bubbles were ignored. Modern financial engineering had supposedly eliminated risk through scientific distribution. Wall Street packaged garbage mortgages into safe securities. Then 2008 demonstrated exactly how well that risk management worked. Reality reasserted itself violently. Today, the dismissive responses sound familiar. You don't understand. This time is different. Old rules don't apply. But mathematics doesn't care about growth narratives. Democracy doesn't care about immunity claims. Both have principles that eventually reassert themselves. The Supreme Court ruling is exactly that kind of reassertion, a reminder that America isn't a monarchy, that the presidency doesn't grant permanent legal protection, that constitutional principles apply universally. Whether you believe the underlying charges have merit or not, that principle matters enormously for institutional stability. Federal cases are going to dominate headlines now. Classified document charges, January 6th charges, election interference charges. The evidence is public and substantial. How the defendant responds matters. He's not accepting judicial authority. He's attacking it, escalating rhetoric, delegitimizing the entire justice system, convincing supporters that courts are corrupt political weapons. That message is economically corrosive. When half the country believes institutions are rigged, those institutions lose effectiveness. Courts enforce contracts through legitimacy, not force. If people stop accepting judicial authority as legitimate, the entire commercial framework begins to crack. Moderate voices are starting to distance themselves from defending the legally indefensible. Even strong allies are publicly criticizing attacks on the Supreme Court. When you lose loyal defenders on core constitutional questions, it signals that defending certain positions is no longer politically sustainable. Legal experts across ideological lines are united. Conservative to liberal, they're calling this ruling one of the clearest judicial rebukes since United States versus Nixon. Former federal prosecutors who often defend controversial positions appeared on television saying the ruling's logic is airtight with zero possibility of successful appeal. Constitutional scholars who defended him during impeachment proceedings described the court's language as devastating to any immunity argument. When defenders of that caliber say the legal fight is over, there are no procedural tricks remaining. This is the end of that particular road. So here's the investment environment: record stock valuations, historic consumer pessimism, institutional stability under direct attack, federal prosecutions accelerating, constant media drama, and an election cycle where all these factors converge and intensify. Holding $382 billion in cash isn't a bet against American business. It's recognition that price matters. Always has, always will. Being optimistic about long-term American innovation doesn't mean paying any price for stocks today. Those are separate questions. Current valuations only make sense if everything goes perfectly for a decade. No recession, no correction, no constitutional crisis, no institutional confidence loss. But things never go perfectly. Something always disrupts the narrative. And when you've paid 50 or 100 or 400 times earnings, there's zero margin for safety. One disappointment, one unexpected event, valuations collapse. The Supreme Court ruling represents exactly that kind of unexpected disruption. It's a signal that political and legal drama isn't fading. It's intensifying. Federal trials, constant appeals, ongoing institutional attacks, all creating sustained uncertainty. What should capital allocation look like in this environment? First, understand what you own and why. If you're holding stocks because they're rising, that's speculation. If you can't explain why a company deserves its valuation based on actual earnings, cash flow, competitive position, you shouldn't own it. Second, build cash positions, not sell everything. But dry powder means you can capitalize on opportunities when they arrive, and they will. The question is whether you're positioned to buy or forced to sell. Third, focus on businesses with real earnings at reasonable valuations. Boring compared to artificial intelligence stocks promising transformation. But boring is profitable. Companies earning real money, paying dividends, trading below 20 times earnings will dramatically outperform when valuations mean revert. They always do eventually. Fourth, embrace volatility as opportunity rather than threat. When crashes come, emotional discipline matters. The investors who profit from chaos are the ones who prepared in advance, who maintained cash, who avoided overvalued positions, who can act when others panic. The biggest risk isn't temporary losses, it's permanent capital destruction from paying unsustainable prices for assets that can't justify their valuations. At 39 times earnings with institutional stability threatened and a former president attacking the Supreme Court, permanent loss risk is substantial. Here's what's visible right now. The court delivered its ruling. Immunity claims were rejected. His own appointees voted against him. Cases are proceeding. Attacks on institutions are escalating. Markets are already fragile from overvaluation. Consumer confidence is near record lows. Bond markets show stress. And we're heading into an election year where all these issues intensify. This isn't normal. When massive cash positions are held instead of finding reasonably priced investments, that's a signal. When hedge funds close because value estimates don't sync with market prices, that's a signal. When the Supreme Court delivers a 7-2 ruling rejecting immunity and gets attacked for it, that's a signal. Nobody has a crystal ball. Exact crash timing is unknowable. But conditions for significant volatility are clearly in place. Warning signs are flashing. Cracks are visible. The Supreme Court ruling is accelerating a political and legal crisis that impacts markets directly. History fills with examples of ignored warnings. The 1920s ended in depression. The 90s tech bubble ended in crash. The mid-2000s housing bubble ended in financial crisis. Each case had clear advance warnings, excessive valuations, unsustainable trends, institutional instability. Each case saw most investors ignore those signs until too late. The pattern of selling stocks every quarter since 2022 reflects reading these signals, building cash, waiting for valuations to make sense, watching institutional stability carefully. Because markets don't just depend on earnings and growth, they depend on confidence, stability, rule of law. The Supreme Court ruling tells us rule of law still matters in America. That's positive for long-term democratic health. But short-term, it creates more chaos, more uncertainty, more volatility, because the ruling isn't being accepted gracefully, it's being fought with everything available. Supporters are following that lead. This political and legal drama will dominate for minimum a year. Federal trials proceed. Appeals get filed. Attacks continue on judges, prosecutors, anyone involved. Legal costs already exceeding $40 million keep climbing. The Republican Party tears between defending an individual and defending institutions. All this plays out against a market already overvalued and fragile. 10 companies account for 30% of the S&P. If they stumble, everything follows. Those companies are increasingly vulnerable. Technology stocks trade at valuations assuming perfect execution for years. Any disappointment, any regulatory challenge, any competitive threat puts those valuations at risk. Concentration in artificial intelligence stocks is particularly concerning. $320 billion spent on AI infrastructure in 2025 alone. 39% increase from 2024. Where are the profits? Services generate revenue nowhere near justifying spending. Features enhance existing products but don't create massive new revenue streams. Investments support platforms, but actual AI products aren't making significant money yet. This is capital expenditure arms race driven by fear of being left behind, not rational return calculations. When fear drives investment, excess capacity and wasted capital typically follow. We saw this in telecommunications in the late 90s, in shale oil in the 2010s, now in AI infrastructure. Arms races produce massive overcapacity. Everyone builds assuming they'll capture significant market share. Not everyone can be right. Someone owns expensive data centers running at 30% capacity. When that becomes clear, valuations adjust violently. So current state, court rejected immunity, cases proceeding, institutions under attack, markets overvalued, consumer confidence weak, AI spending unsustainable, bond markets stressed, election year where everything converges. Preparation means significant expected volatility, holding cash, avoiding overvalued positions, focusing on businesses with real earnings at reasonable prices, watching institutional stability, because when rule of law is under attack, when claims of being above law persist, when half the country believes institutions are rigged, that creates systemic risk. The court did its job, ruled based on constitution, not political loyalty. But the battle continues. The ruling isn't being accepted. Escalation is happening. That escalation creates more chaos, uncertainty, risk. Simple advice: be prepared. Build cash. Avoid overvaluation. Focus on quality at reasonable prices. Understand we're living through extraordinary institutional stress. Markets might continue rising. Bubbles inflate longer than rational expectations suggest. But when they pop, it's fast and hard. This ruling is a defining moment for American democracy. It reaffirms nobody is above law, but it sets the stage for months or years of legal and political warfare. That warfare impacts markets, economy, investments. 70 years of watching every kind of market, every kind of crisis, every kind of bubble and crash inform this view. Current environment requires extreme caution. Warning signs are everywhere. The question is whether investors pay attention before too late. History doesn't repeat, but it rhymes. We've seen this pattern: excessive valuations, institutional instability, denial anything is wrong. Then something breaks. A ruling, a bankruptcy, a default. Something exposing the fragility of the entire system. The Supreme Court ruling is one of those moments, exposing fragility of legal positions, fragility of political strategies, fragility of a market priced for perfection in an increasingly imperfect world. Stay disciplined. Focus on fundamentals. Remember, the time to build your ark is before rain starts. Storm clouds are gathering. The ruling is just the latest indication we're heading for turbulence. Biggest risk isn't temporary losses. It's permanent capital destruction from paying too much for assets that can't justify valuations. At 39 times earnings, with institutional stability threatened, with attacks on the Supreme Court, permanent loss risk is very real. The ruling tells us American institutions still work, rule of law still matters, Constitution still applies to everyone, encouraging long-term, but short-term means more chaos, more volatility, more risk. In an already overvalued market, that's dangerous. Price is what you pay. Value is what you get. Right now, prices are high and values are questionable. That's not when aggressive investment makes sense. That's when patience, caution, and preparation for eventual opportunity matter most. Let me go deeper into something troubling about reactions to this ruling. When conservative Supreme Court justices appointed by a Republican president rule based on Constitution rather than political loyalty and get accused of deep state conspiracy, we've entered dangerous territory. 70 years of watching American politics provides perspective. Liberals angry at conservative rulings, conservatives angry at liberal rulings, that's normal. That's democracy functioning. What's happening now is different. Not just disagreement with a ruling. Systematic attempt to delegitimize the entire judicial branch. That has direct economic consequences most people aren't considering. Think about what courts do in modern economies: enforce contracts, protect property rights, resolve business disputes, provide neutral forums where companies and individuals settle disagreements without violence or corruption. This neutral arbitration system is absolutely essential for prosperity. When investing in a company, part of the bet is that rule of law will be enforced. If the company has a patent, courts will protect it. If the company signs contracts, courts will enforce them. If the company faces unjust lawsuits, courts will dismiss them fairly. Remove that trust, and investing foundations crumble. Imagine a world where half the country believes courts are illegitimate political actors, where judicial rulings get accepted only if they favor your side, where losing means the judge was corrupt rather than your case was weak. What happens to business in that environment, to long-term investment, to economic growth? This is why institutional stability isn't abstract political science. It's bedrock of economic prosperity. Countries with strong, trusted institutions have strong economies. Countries with weak or corrupt institutions have weak economies. No mystery. The data is overwhelming. Rule of law matters for economic growth. The United States has been fortunate for 250 years. With notable exceptions, relatively strong institutions, courts mostly following law, Constitution mostly respected, checks and balances mostly working. This institutional stability is a huge part of why America became the world's largest economy. But institutional stability isn't permanent, requires constant maintenance and defense. When powerful people attack institutions, refuse legitimate legal rulings, convince followers the entire system is rigged, stability starts eroding. Once erosion starts, it accelerates quickly. Other countries demonstrate this. Venezuela had South America's richest economy in the 70s. Institutions weakened, rule of law eroded, property rights became uncertain, contracts became unenforceable. Within a generation, prosperity turned to poverty. Argentina ranked among the world's 10 largest economies in 1913. Institutional decay led to decades of stagnation. These aren't ancient examples, recent cautionary tales. Not saying America becomes Venezuela or Argentina. Much stronger institutional foundations, much deeper commitment to rule of law. But institutional erosion is real risk with real economic consequences. Right now we're watching sustained attack on American institutions by a former president commanding loyalty from tens of millions. The Supreme Court ruling is significant because institutions defended themselves. The court said you are not above law, encouraging, but the battle isn't over. The ruling isn't being accepted. Doubling down on attacks, supporters following that lead. This creates difficult environment for long-term investors. How do you value a company when institutional stability is questioned? How do you project earnings 10 years out when property rights enforcement is uncertain? How do you calculate risk when political and legal instability increases? These questions matter more than whether specific AI companies or tech stocks are overvalued. Those are tactical questions. The strategic questions are about system stability, because if the system breaks down, if institutions lose legitimacy, if rule of law becomes optional, all the stock-picking skill in the world won't save portfolios. This is why cash emphasis matters. Not because stocks are going to zero, because we're entering extraordinary uncertainty. In uncertainty periods, cash provides optionality, lets you wait and see developments, take advantage of opportunities when they arise, protects from forced selling at worst moments. Let me explain something about crashes most people miss. Really devastating losses don't happen during initial crash. They happen during recovery that never comes. In 2008, stocks fell 50% peak to trough. Terrible. But holding quality companies without panic led to recovery and beyond. People who got truly destroyed held companies that went bankrupt. Lehman Brothers, Bear Stearns, hundreds of smaller financial institutions. The danger right now isn't just overvalued stocks might crash. The danger is some companies are built on foundations that won't survive real stress tests. Companies depending on perpetually cheap capital. Companies never showing profit. Companies whose entire business model assumes next funding round will always be available. When music stops, when capital becomes expensive or unavailable, those companies don't just decline, they disappear. If you're holding them, you don't get recovery. You get permanent capital loss. This is why valuation matters intensely. Paying 100 times earnings for a company leaves zero margin of safety. One bad quarter, one competitive threat, one change condition, that stock can fall 80% and still be overvalued. Some people hear this as pessimism about America. It's not. Bullish on America's long-term future as ever. American ingenuity, entrepreneurship, innovation. Real and powerful forces. The United States will continue leading in technology, business, economic growth. Companies dominating the world economy in 2050 will mostly be American. But being bullish on America doesn't mean being bullish on American stock prices today. Those are different things. American business can thrive while stock prices decline from overvalued levels back to reasonable levels. In fact, that's usually what happens. Economy grows, businesses create value, but stock prices fall because they started from unsustainable valuations. This distinction gets lost in bull markets. People conflate positive economy with positive stock valuations. Not the same. Stock market can be terrible investment when economy does well if prices are too high. Stock market can be great investment when economy struggles if prices are low enough. Right now, worst possible situation. Economy showing stress signs. Consumer confidence weak. Institutional stability questionable. Stock prices extremely high. Not a recipe for good returns. Recipe for disappointment at best, disaster at worst. The Supreme Court ruling crystallizes these concerns, reminds us political and legal drama isn't fading, intensifying. Next year or more spent fighting federal prosecutions, continuing to attack judges, prosecutors, Anyone involved in accountability? Supporters continuing to believe system is rigged. Constant drama backdrop for every business decision, investment decision, economic forecast. Based on what's visible, declining risk seems less likely scenario. So same advice returns. Be careful. Be disciplined. Build cash. Avoid overvaluation. Focus on quality businesses with real earnings at reasonable prices. Be prepared for significant volatility. The ruling is signal we're in for turbulent period. How turbulent and how long, nobody knows. But preparation beats being caught off guard. 70 years of learning to read market signals, separating noise from signal, identifying when markets price in too much optimism or too much pessimism. Right now, signals are clear. Too much optimism on valuations, too little concern about institutional stability, too much belief everything works out fine, too little preparation for when it doesn't. History will remember this Supreme Court ruling as a defining moment, when American institutions stood firm against direct constitutional challenge. But history will also record what happened next in markets, economy, American democracy. How that unfolds depends on choices being made right now by investors, business leaders, citizens. The choice is clear. Preserve capital, maintain flexibility, wait for better opportunities. Because 70 years teaches that patience gets rewarded and impatience gets punished. The ruling happened moments ago, but implications will unfold over months and years. Stay alert, stay disciplined. Remember, in investing, as in life, it's not about timing the market perfectly. It's about being prepared for whatever comes.